What are gilts or UK government bonds? Gilts are loans that you, as an investor, give to the UK government. In return, the government agrees to pay you back later, with a bit of interest along the way. Think of it like this: you lend the government some money, and they promise to return it on a set date, with regular payments called coupons in the meantime. They're called gilts, because the original paper certificates had gold edges. These days it's all digital, but the name stuck. Why does it matter? Gilts are seen as one of the safest ways to invest money in the UK. Since they're backed by the government, there's very little risk that you won't get your money back. That makes them especially popular with people who want to protect their savings or earn a steady income, like those nearing retirement or looking for balance in their investment mix. They're also useful for big institutions like pension funds, insurance companies, and even foreign governments. Gilts give them a reliable place to park large sums of money, often for the long term. Here's a simple example. Let's say you buy a gilt for £1,000. It pays 2% interest a year and lasts for 5 years. That means you'd get £20 each year, or 2% of £1,000, and at the end of the 5 years you'd get your original £1,000 back. In total you'd earn £100 in interest, plus keep your starting money. Simple and predictable. What else should you know? 1. How do you buy gilts? You can buy gilts through most investing platforms, through brokers, or directly at government auctions run by the Debt Management Office. Some people also invest in gilt funds, which are collections of different gilts bundled together. 2. Gilts versus savings accounts. At first glance, gilts might seem similar to savings accounts, but there are key differences. Savings accounts are simpler and often come with flexible access, while gilts may offer higher returns, especially if you hold them for the full term. But gilt prices can go up and down if you sell early. 3. Interest rates and gilt prices. Here's an important point. When interest rates go up, the value of existing gilts usually goes down. Why? Because new gilts offer better rates, making older ones less attractive. So, if you sell a gilt before it matures, you might get back less than you paid, depending on what's happening in the wider economy. 4. Inflation and index-linked gilts. There's another risk too: inflation. If prices rise quickly, your gilt interest might not keep up, meaning your money loses purchasing power. That's where index-linked gilts come in. These adjust their interest payments in line with inflation, helping to protect your returns. 5. Gilts in the news. You might remember gilts making headlines in 2022 during the UK's mini-budget crisis. Investors lost confidence, gilt prices fell sharply, and pension funds were caught off guard. It was a reminder that while gilts are usually stable, they can still be affected by political and economic shocks. To sum it all up, gilts are a way to lend money to the UK government in return for regular interest payments and your money back later. They're low risk, fairly simple, and widely used by both everyday investors and big institutions. But like all investments, they come with trade-offs. Interest rates, inflation, and timing all matter. Still, for many, gilts offer a calm and steady place to grow their money. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.